In today's market update, we're going to be taking a look at the price of gold. It is the 4th of September, and if you are in the United States, I hope that you are enjoying a relaxing Labor Day weekend. It has been 6 weeks since we last took a look at the price of gold, and so it is time for us to update the situation and understand what has been happening. In the previous market update, which was recorded over here on the 24th of July, I was speaking about the probability that the 40-week cycle trough had formed, and the likelihood was that it had formed over here at the end of June. As you can see in the analysis at the foot of this chart, I have done some pinning. These pin symbols mean that I have influenced the analysis that Sentient Trader is performing. Why have I needed to do that? The reason is that recently the trough analysis, in other words the analysis that assumes that the cycles that are influencing the price of gold are synchronized at their troughs, has not been very clear in the market. In particular, you can see we have a 40-week cycle trough over here at the end of June. Then price bounced up out of that trough, but it has come down and it has tested that low over here in a trough that I have phased as an 80-day cycle trough. Some analysts might suggest that the 40-week cycle trough would be better placed over here, and indeed that is possible, as I discussed in the last market update about gold, in which I discussed the fact that this big cycle trough that I believe formed here at the end of September might in fact have occurred slightly later over here in the beginning of November. But rather than discussing the subtleties of that analysis, I would like to take a slightly bigger picture view in today's market update and discuss why it is that in the price of gold we had these three troughs over here that were very nearly equal, and again we have a situation where we have a fairly large cycle trough and then another trough that tests that low so soon after it. Why is that? In my opinion, it is because the price of gold is influenced by cycles that are synchronized at their peaks. I've discussed this in previous market updates about gold, so I'm not going to dwell on it too much, but I will point out again that Hurst performed his initial research in the 1960s and 70s into the price movements of US stocks, and he discovered that those price movements were influenced by cycles synchronized at their troughs. He also discussed the analysis of gold in his cycles course that he published in the 1970s, and suggested that gold was influenced by different cycles. However, recent work in the field of Hurst cycles by both myself and many other cycle analysts suggests the possibility that the peaks of gold are synchronized as opposed to the troughs. This is particularly clear in other precious metals, and it is also very clear in many commodities, such as, for instance, the price of coffee. Gold is an interesting instrument because it seems to respond to both cycles that are synchronized at their peaks and also cycles that are synchronized at their troughs, which is why I do always consider a trough analysis when considering gold. In the recent update about gold, which was published 6 weeks ago, a commenter on YouTube pointed out that I didn't in fact show the peak analysis, which was an omission on my part. I should always show the peak analysis of gold because often the peak analysis is better than the trough analysis. And the fact that gold is influenced by cycles synchronized at their peaks shows in the price of gold, particularly in terms of these rounded and clustered troughs that tend to form in gold, whereas the peaks are usually sharp and isolated. And so, in my opinion, that is what has been happening in gold, is that we have been focusing on the trough analysis, or I have been focusing on the trough analysis, whereas the peak analysis must be considered. And so we are going to consider the peak analysis in today's market update, and I'm going to show you how I tend to consider both of these analyses at the same time in gold, which might sound like a bit of a riddle, but I will explain to you how I do that. First of all, I would like to backtrack a little bit. We're looking at a weekly chart here of the same analysis, and in the previous market update about gold, published over here on the 24th of July, I discussed the fact that the price of gold had crossed above the 80-day FLD, that cyan-colored line, and that it would be expected to cross above the 20-week FLD, which is this green line over here, given the fact that this was probably a trough of the 40-week cycle. So what happened? Well, as you can see, price moved towards that 20-week FLD, but it didn't even touch it. In other words, it didn't even find resistance at the level of the FLD, and it certainly failed to cross above it. So that was an early warning sign that something was wrong. As price failed to touch the 20-week FLD, we realized that something was happening here and that there had been a bit of a failure in terms of the trough analysis. Interestingly, the trough analysis was not wrong, in my opinion. I continue to believe that the 40-week cycle trough did occur over here. But the fact that we witnessed such a failure in terms of price not getting above the 20-week cycle FLD indicated that something was happening. What was that something? That something was, of course, the influence of the cycles that were synchronized at their peaks. Because here, according to this analysis, we had an 18-month cycle peak that occurred at the beginning of May. An 18-month cycle peak in the peak analysis indicates, of course, some bearish pressure. What is happening in this analysis at the moment, as you can see, and this is why I'm speaking about gold today, price is back here at the level of the 80-day FLD on the weekly chart, and it has just squeezed up above the 20-week cycle FLD, potentially providing us with a target if median price succeeds in crossing above that FLD somewhere over here at about the $2,000 level, which is when we would expect the 20-week cycle peak to occur according to the peak analysis. So let's turn our attention to the peak analysis. This is still a weekly chart, and as you can see, we have an important peak over here, a peak of 9-year magnitude that occurred in August of 2020. We had our first 18-month cycle peak over here in early 2022. Let's measure the number of days in between those peaks, and the average number of days for an 18-month cycle discovered by Hurst 50 years ago is, of course, 546 days. That is not exactly 18 months, and if you don't understand why the average length of an 18-month cycle is 546 days, I would encourage you to download the 10 core concepts of Hurst cycles document that I will provide a link to in the description below this video. There were 581 days, as you can see, that elapsed from the peak in 2020 to the peak in early 2022. So that was an 18-month cycle peak that was potentially about 35 days or about a month late. And if you go back to the market update videos I was recording at the time for gold, you will know that, of course, we were anticipating that 18-month cycle peak. What about the next 18-month cycle? Now, this is where the peak analysis begins to get just a little questionable, because you can see only 417 days elapsed into that cycle peak. The average length of an 18-month cycle at 546 days would lead us to expect that 18-month cycle peak to occur about now. Is it possible, therefore, that gold is going to suddenly spring upwards and form an 18-month cycle peak now, and only then turn down from the 18-month cycle peak? It is possible, but for various reasons that I'm not going to dwell on now, because it gets a little complicated when you discuss the complexities of an analysis, the chances are good that this 18-month cycle peak lies behind us. So how do we work with two analyses on a chart? We have a trough analysis and we have a peak analysis. The way that I like to approach it is I will consider one analysis at a time, and then I will ask myself which analysis best matches the price action. And gold is an interesting instrument, as I've already mentioned, because of the fact that I find that gold tends to move from periods of time in which a trough analysis works better to periods of time in which a peak analysis works better. Let me show you what I mean. One way of understanding the implications of an analysis are to display the composite model line. Here is the composite model line based upon the trough analysis only. It is not including the information from the peak analysis. You will notice that this composite model line matches price action fairly well. However, it clearly misses out the strong rise up into this peak, and the price rise into this peak was also a little more dramatic than was expected based purely upon the trough analysis. However, in recent times, as you can see, in other words, from this period in about July of this year, all the way up until about the end of June this year, the composite model line on this time frame, in other words, we're looking at a bit of a large scale picture here, but on this time frame the composite model line matched fairly well. We're going to zoom in a moment and consider what happened recently, because that has been an interesting shift from the trough analysis to the peak analysis, in my opinion. But let me not jump the gun. Let's consider first of all this composite model line and what it tells us about the analysis. The price of gold has been trapped in what might be described as a fairly wide range since about the middle of 2020. Price has come up, formed a peak, come down again, formed a trough, up to a peak and back and forth. So it's trapped in a bit of a long-term range. During that period of time, the trough analysis has matched fairly well, which is why I have tended to watch the trough analysis more closely than I have watched the peak analysis. However, recently there has been a bit of a shift. Let's consider now on this same scale of zoom the composite model line for the peak analysis. There it is, and you will notice that the peaks, of course, not surprisingly, match much better. You must bear in mind that the composite model line is a little bit like a mathematical conjuring trick, because what we are doing is performing a cycle analysis upon the data. We're extracting information about those cycles in terms of their wavelength and amplitude, and then we are recomposing that information to produce this line. It is not a surprise that the line matches fairly well. It's a bit like one of those mathematical tricks where somebody says, think about a number, multiply it by this, divide it by that, add this, subtract that, and so forth, and hey presto, you end up with the same number. It's not really a surprise. But what is interesting is where the composite model line does not match the price action. Where it does match the price action, it tells us that the cycle analysis is providing us with an accurate analysis of what price action was doing at the time. In other words, there is a strong likelihood that the cycles that have been found in the analysis were indeed influencing price in the manner presented in the analysis. However, where there is a difference between the composite model line and the price action, there is clearly some kind of an anomaly. And you will notice that over here, during this period of time here, there is a very clear difference between the composite model line, which was expecting price to rise up to a 40-week cycle peak over here, and the price action where price fell down into a 54-month cycle trough. And so neither the trough analysis nor the peak analysis perfectly describes what has been happening in this market. However, when we combine the information from the trough analysis and the peak analysis, we get a composite model line that matches the price action a good deal better. It is not perfect, but it provides us with a better match between the composite model line and the price action. In other words, the combination of the peak analysis and the trough analysis have provided us with better information to understand why price has moved in the way that it has. Now let's zoom in and consider what has been happening recently in the price movement of gold. If we display the composite model line at this zoom scale, this is the composite model line based only upon the troughs, or I should say upon the trough analysis. As you can see, the composite model line matched price action fairly well. We had a peak over here and then another peak over here, and then we had a strong move down into this trough. It matched fairly well up until this point over here, which is the point at which the price movement drifted away from the composite model line. Of course, we do have a trough in the composite model line, which is synchronized fairly well with the trough that formed in the 3rd week of August. But there is clearly a deviation between the composite model line and price action. What has happened? In my opinion, what has happened is that gold has started being influenced more by the peak analysis. or by the cycles that are synchronized at their peaks. The obvious next question is, why is that? Or what are these cycles that are synchronized at their peaks as opposed to the troughs? The truth is, I don't have the answer to either of those questions. I do not know why a particular market might shift from cycles synchronized at their peaks to being influenced by cycles synchronized at their troughs. I also don't know what these cycles are. Many people have suggested possibilities, and there are some very interesting ideas around that, but that will have to be a discussion for another time. And so, in my opinion, gold has started being influenced more by the peaks recently than it has been by the troughs. Let's take a look at the composite model line based upon the analysis that assumes that the cycles are synchronized at their peaks. There is the composite model line, assuming that the price of gold is influenced by the cycles that are synchronized at their peaks in the analysis shown at the top of the chart. As you can see, it provides a very different picture because, of course, price is expected to move down as opposed to move up, which is what we saw in the previous composite model line. Why is price expected to move down? Clearly, it is expected to move down because of the fact that, according to this analysis, an 18-month cycle peak occurred over here at the beginning of May. As mentioned, it is possible that that phasing of the 18-month cycle peak is incorrect. We might have an 18-month cycle peak still lying ahead of us, but considering the analysis we have on our chart at the moment, this would suggest that we are entering into a bearish period of time, certainly to carry price down into this 80-day cycle trough, which will also be a 20-week cycle trough if these cycles are synchronous at their troughs, which of course they might not be, and that would be expected to occur in about the third week of October. So how do we work with these two conflicting analyses? It's an interesting situation because very often a peak analysis and a trough analysis will suggest the same price movement, because price will bounce from a trough into a peak. It'll form the peak and then it'll move down into the next trough. And so often these analyses provide us with the same information, or they corroborate one another. At the moment in gold, however, they are not supporting one another and we have a conflicting picture. In that situation, I combine the information from the trough analysis with the information from the peak analysis, and we present a composite model line that is composed from both analyses. Here is that composite model line, composed by a combination of both the cycle analysis that assumes troughs are synchronized and the analysis that assumes that peaks are synchronized. As you can see, it gives us a fairly well-matched movement between price and the composite model line. You can see that the composite model line implies that we are now in a move up out of the 80-day cycle trough into this 20-week cycle peak that we can see the nest of highs for over there. That peak is expected to occur in about the second week of September, and then price will move down into this 20-week cycle trough, again assuming that it will be synchronous with the 80-day cycle trough, which it might not be, in about the third week of October. So how do we work with this information? Well, we are certainly expecting price to rise up and form a peak, and we're going to be on the lookout for that peak to form. But we are going to remain aware of the bearish possibilities of the peak analysis, which is shown in this composite model line, indicating that the bounce out might be a disappointing one. We will experience the same peak, of course, and then we will get the move down into this deeper trough over here. However, we will also keep an eye on this composite model line, or the analysis created by the cycles synchronized at their troughs, indicating that the peak might occur later and a good deal higher than if the peak analysis is the one that is influencing price movement. We will still get a move down into the same trough at about the same time, but our expectation will certainly switch towards a more bullish picture. Bear in mind my comments earlier about this 18-month cycle peak, which also supports the possibility, if the 18-month cycle peak still lies ahead of us, of some bullish price action in gold. How are we going to track this price action? We are, of course, going to keep an eye on our future lines of demarcation, Hurst's FLD, and we are going to watch as price interacts with these FLDs. And of course, there is an FLD for each and every cycle. I'm simplifying things slightly by only showing the 80-day cycle FLD and the 20-week cycle FLD here. And we are going to calculate the targets as price crosses over those FLDs and watch as price approaches those targets to see whether we have indications of bullishness or bearishness in that price action. I do hope you have found this market update useful and interesting. If you have any questions, please put them in the comments below this video or join us on our Hurst Cycles Discord server. I look forward to hearing from you.